Hey traders, welcome to part 1 of the pound Australian dollar technical analysis. First off though, I want to apologize for the delay in this video. I know it's been a long time coming, but I hope the quality and the content makes up for the wait. I broke up this video in 2 parts just due to the fact that it was such a large analysis and I didn't want to cram too much content into one video. So it will have 2 separate parts. That way any questions in regards to part 1 and part 2 can be separated and we can have a more productive discussion in terms of the questions that arise. So with that being said, I hope you all enjoy part 1 of the pound Australian dollar technical analysis. The first chart I want to take a look at is the quarterly chart for the pound Australian dollar market. The reason for this is I like taking a top-down approach when I trade the foreign exchange market. Looking at the longer term charts first allows you to be able to spot either very significant turning points in a trending market or finding a nice trending market to jump in on and ride the momentum. So utilizing these longer term charts allows you to see price action that is extremely accurate. Remember that each bar represents 3 months. So utilizing these longer term charts is crucial in finding longer term trades, and then you go down into the lower time frame, time your entries, and then move back out to the longer term charts to ride that trade and milk out as much profit potential as possible. With that in mind, taking a look at this quarterly chart, the thing that stood out to me right away was this low we saw back in the second quarter of 1996 at this key 1.88 level. If you look closely, we did approach this level once again in the first quarter of 2014 with this previous supportive level now acting as new resistance. Notice how we got a pretty decent bearish rejection candle rejecting this 1.88 level. However, something very interesting happened once that candle formed. If you zoom out, this pound Australian dollar market is overall a bear market. We still have lower lows and lower highs being formed. So keeping that in mind, if you think of being a bear in this market, this would be a great area to short this currency pair. Reason being is this was such a significant key supportive level, and then we got a nice rejection of that level with a nice technical signal. So anyone who was short this market was either looking to add on to their position, or newer traders were looking to join the overall bear trend, staying with the momentum. But something very interesting happened once that candle formed. The complete lack of follow through we saw in the next 2 quarters was crucial, and this was the turning point in this market. If you notice, the next quarter we got a doji, and then following that for the third quarter of 2014 we had a large bullish pin. So we had a complete rejection of lower prices in a bear market with old support turning into new resistance and a technical signal. This showed the strength of the bulls in this market. The fact that they were able to defend this level around 1.73 and rally indicated to me that we were definitely going to head higher. And one other thing I wanted to note, once those rejections of lower prices took place, if you measure the last major swing high around 2.7 to the lows at 1.47, you can see that the next key supportive level isn't until 2.075, and that just so happens to be the 50% retracement level of this last entire move. So once I saw this rejection of lower prices, that was a crucial indicator that the next stop would be the next key level, and that just so happened to be 2.075, which coincided nicely with the 50% retracement level. So now that we saw the shift in momentum on the quarterly chart, I want to now jump to the monthly chart so we can see the price action a bit better. Taking a look at the monthly chart, there are a couple of key indicators which did support the theory of a move higher just based on the quarterly charts. If we take a look at the monthly chart, first thing I want to look at is the fact that we closed above this 50 MA back in October of 2013. Looking back on this market, you can see we have not closed above the 50 MA on a supporting basis since 2002. So the fact that it took 11 years to close back above the 50 MA is a huge sign that things may be shifting. So that is a major signal in terms of the strength of the bulls on the monthly chart for the pound Australian dollar. One other thing that is pretty interesting is you measure that last tiny swing high we saw back around 1.78, measuring that swing high to the lows just under 1.47. Notice how as we closed above the 50 MA back in October of 2013, that was also a nice rally above the 0.618 retracement, and then utilizing that retracement level as new support. So not only did we close above the 50 MA for the first time in 11 years, we also closed above the 0.618 retracement, failing to make a lower high. So if we remove this Fibonacci level, you can see then we did rally higher up to 1.88. Remember, that was the key level we pointed out on the quarterly chart. And once we reached that key level on the quarterly chart, we did get a initial move lower, which did create that bearish candle we saw on the quarterly chart. Remember, it takes 3 months to form each bar. We then had a bit of consolidation in the summer of 2014, which formed the doji candle on the quarterly chart. And then we got a significant rally to end September of 2014, which formed that large bullish pin. Also to note is on the monthly chart, if you measure this swing low around 1.67 to the high at 1.88, notice how we rallied perfectly off the 0.5 to 0.618 retracement, rallying higher, forming a large bullish engulfing candle, which then formed that large bullish pin on the quarterly chart. So that alone was a lot of evidence for some bullish strength in this market and that we may be heading higher. One other thing to note is we did have this minor level here on the monthly chart around 1.78. Notice how it did provide resistance in July of 2010. We then rallied above that level, found support, and again that was the 0.5 to 0.618 retracement level that we rallied off of as well. Notice how we did find support once again on that 50 MA, basically confirming that the bulls are stepping in whenever we reach this 50 MA, and we did form a higher high and a higher low. So all of this combined with the quarterly chart was a lot of evidence. And now if we go into the weekly chart, you can really see how the price action plays out perfectly. Textbook price action and a very easy signal to get long on this currency pair. Taking a look at the weekly chart now, the first thing I want to point out is the fact that in the beginning of 2014, we had the 50 MA cross above the 200 MA for the first time in 10 years on the pound Australian dollar market. So that is a massive indicator in terms of a shift in sentiment. That's not even counting the quarterly or the monthly. So let's stack on that confluence as well in terms of looking for a buy signal. So zooming in again now, I want to take a look at the last major monthly swing high we pointed out on the last chart, back to the lows just below 1.47. As we mentioned on the monthly, we did rally above this 0.618 retracement, failing to make a lower high and then utilizing this 0.618 retracement as new support. One thing I want to point out, however, is notice how as we broke above this 0.618 retracement, not only were we finding support above the 50 EMA on the monthly chart, we were starting to find support on the 200 MA on the weekly chart as the 50 MA was starting to cross back above the 200 MA for the first time in 10 years. So not only did we have this minor resistance at 1.66.5 acting as new support, breaking above the 0.618 retracement, utilizing that as new support, utilizing the 200 MA as new support, and the 50 EMA coming in crossing above the 200 MA. So there was a ton of confluence on the weekly chart as well as the monthly and the quarterly to support getting long on this market. If we remove the Fibonacci levels, you can see that the market makers did notice this and they took us from 1.66.5 all the way up to the highs at 1.92. That is a massive move to end 2013. I did move the level from 1.88 to 1.92 because we can see as we zoom in to the weekly chart, we can start to fine tune our levels, and I saw 1.92 as the better level to place on the weekly. So just a good example of adjusting your longer term levels as you start to drill down into the price action and are able to see it a bit better. So the next thing I want to do is take a look at the overall trend in this market and what's known as an ABC complex pullback. So we can see we were starting to form higher highs and higher lows. Notice higher high, higher low, higher high, higher low, higher high at 1.92, and then we retraced all the way down to 1.73, but we did retrace in what's known as an ABC complex pullback. What this means is essentially it's a two-leg pullback before resuming the overall trend on a currency pair or any asset class. So we can see that we rallied all the way up to 1.92, then we formed a higher low at 1.78, then a rally to 1.83.5, forming a lower high, and then forming a lower low to 1.73 before we started to resume the trend. So this is the ABC pullback, the letter A being the initial move lower to 1.78, the first lower high being the B at 1.835, and then the second move lower, the second leg lower in the pullback to 1.73 being C. And once we reach the C level, you'll notice how the trend resumed. We formed the higher high and then started trending higher. So that's what's known as an A, B, C complex pullback, and then the trend resumes. So one way to see these on your charts is to really look at the overall context of the market. Yes, we did form a lower high here at 1.83.5 and then a lower low at 1.73. But notice when comparing it to the last major swing low on the weekly chart at 1.66.5, we were still putting in higher lows on this currency pair. So although we did form a lower low in context of the low we saw at 1.78, it was still higher to the low we saw at 1.66.5. So just a complex pullback, but it was still keeping up with the overall trend of higher swing lows in this market. So once we completed that ABC complex pullback and we started to trend higher, we did start forming these two nice trend lines which created an ascending channel. So once we surged again to 1.92, I was looking for a pullback to get long on this market as we were trending higher. We had so much confluence to look for a buy signal as we started to drill from the top down. So I measured that last swing low we saw around 1.78 to the highs at 1.92. And I was looking for a buy signal in the 0.5 to 0.618 retracement level around this key support and resistive level at 1.835. So preferably I was looking for a doji, low test candle, anything that would be rejecting the Fibonacci area, the trend line, the key supportive level, and we would be trading with the overall trend. And we did get a signal that things were about to shift. However, it's not one that many students know about. It's what's known as an inverted hammer. We all know what a high test candle is. We all know what a pin bar is at the top of an up move. If we see this type of candle, it is a signal that things may be shifting back and we may get a decent pullback. So it is a loss of upside momentum once it occurs after an up move. However, when we see a high test candle at the end of a pullback, at the end of a down move, it actually means the opposite. What this is telling us is that buyers actually stepped in that week, bringing price all the way up to 1.88 before the sellers came back in and drove price back down. However, that is an early warning sign that there are buyers lurking around this 1.835 level and they are looking to buy this market. So this is a warning sign for any bears to start looking to step out of their position, especially since they were trading counter trend to the overall weekly trend. What's pretty insidious about these inverted hammers is the fact they are utilized as bear traps. So many new traders who either don't understand price action or just don't understand basic technical analysis will see this as a sell signal, thinking that it's showing weakness to the upside and that the bear should continue to drive price lower. However, like we explained before, it is a trap. It signals that buyers are there just beneath this candle. So what will happen is oftentimes price will dip just below this candle because most new retail traders would have their entry just below, probably around 1.838. And they'll either have their stop around the middle of the candle, 1.86, or just above at 1.88. So if you notice in the beginning of the week, price did dip lower, just low enough to trigger in any new retail traders looking to trade this candle short, just enough to trigger them into their trade. And once we dipped low enough, we then had a massive rally, forming a bullish engulfing candle the following week as short traders started to cover their positions and their stop losses were being taken out. Notice how we barely backed off the highs as many stops were around 1.88, causing one last surge of momentum to the upside. So once I did see this candle form, this inverted hammer on the weekly for the week of January 12, 2015, that signaled to me to look for any daily signal to get long on this currency pair, whether it be a low test candle, doji, etc., somewhere to get long, because once I saw this inverted hammer occur at this key supportive level at 1.835, it was at the Fibonacci level of 0.5 to 0.618. We were at the bottom of the ascending channel, had that trend line support, and the fact that we had the 50 MA just below. That was plenty confluence for me. That's not even counting the monthly or the quarterly to start to look for a long trade on this currency pair. And then I drilled down to the daily and I found the signal. So that brings a conclusion to the first part of the pound Australian dollar analysis. I just wanted to break this up into two parts as I know there will be quite a bit of questions on how I found these levels, how I'm looking at these trends, etc. So I hope you enjoyed part one of the pound Australian dollar in-depth technical analysis. I look forward to seeing you in part two.